This 106 represents the amount of profit we share at the group level, whether it's associate, whether it's subsidiary. Put in the 106 because this is a post-profit that we share, then you must take away the NCI. This method A, this method B. Method A is the proper step. You do 100% consolidations, you do the adjustment entry, consolidation, then do a deconsolidations. Method 2 is the shortcut method. We do not add out the subsidiary. The entry that we pass before the loss of control, we reverse. The entry we pass before obtain control, reverse. You can see this and this, at the end of the day, you have the same answer. 238, 238. 775, 775. Share cap, 236. Then there's a gain of loss of control, 37, 37. You can see that method 1 and method 2, at the end of the day, get the same answer. This is the proper method. Consolidate, then deconsolidate. The second method is, do not add out the subsidiary, but you still have to pass the consolidation adjustment. Then you have adjustment entry to reverse whatever you pass. Then the third method is a super shortcut method. You don't consolidate at all. You do not do the adjustment for subsidiary at all, but you want to achieve the same column we have here. Under the method C, you pass a terminal entry. The terminal entry means it's the net of this. Instead of doing entry 1, 2, 3, 4, 5, and 6, we show the net of this, show as one entry. We call it as terminal entry. At the company level, we adjust to group level. We use one entry to change from company level to group level. We call it as terminal entry. 690 at the company level, at the group level, it becomes 0. This is no longer an investment, it becomes an associate. Take out 690, transfer to associate. This is 775. Must account for a share of the profit before the control is lost. You have to change from the gain at the company level to a gain at the group level. This is the net entry to take out 58 and to put in 37. This is a net entry to do so. The net assets after the deconsolidate is 2368. The associate at fair value, which the cost is 775. Share cap, retained earning, gain on loss of control. There are three different ways to achieve the same column. I purposely put it here so that you can see the three differences. In practice, this is the proper method. For an exam, this method may be used, and the other two methods may also be used. In the early part of the QP exam, the examiner is using this method. But recently, the examiner is using this method. You may want to consider this method or this method. We don't use this method anymore from now. We should use A and B method. A is the proper method. In fact, this is the method adopted in practice. Prepare financial statements of a company for 2 years. If this year there's loss of control, last year is still a subsidiary. If last year is still a subsidiary, you still have the last year figure. This is the proper method to do the deconsolidation loss of control. However, in exam, there's shortcut method. Shortcut method means we do not consider this. Whatever entry you pass before the control is lost, you have an entry to reverse. Please refer to page 81. Question 1.7 is a Module A questions. This question discusses the changes on parent interest in subsidiary involving loss of control and no impact on control. Study the questions, understand the issue. We go discuss this question shortly. Part A, we're required to calculate the goodwill arising on acquisition SPL at the acquisition date, 4 marks. This should be quite straightforward. B, assuming that there's no transaction other than disposal of share SPL on 1st Jan 2014, advise the treatments and journal entry and calculations in MHL separate financial statement and the consolidated financial statement on how do we account the disposal of share on 1st Jan 2014 if there are two scenarios, first and second. The first scenario is assuming that the disposal of share on 1st Jan 2014 caused MHL to lose control of SPL. Loss of control means we must do a deconsolidations. You have to think about the step to do deconsolidation. You have to mention that, apply to questions. and the control of SPL remains. If the control remains, that means control is unaffected. In this case, we have to adjust the NCI. Advise, calculate, and prepare the journal entry. For Module 11, you are expected to do the same, maybe in the form of preparing a memo. For Part C, we are required to prepare the worksheet, assuming that the control of SPL remain unaffected. Assuming that you are the accounting manager LUM, on 1st Jan 2012, we are now at 31st December 2013. And the question mentioned that the disposal is on 1st Jan 2014, one day after 31st December 2013. On the day we obtain control, this is the acquisition date. MHL acquired 60% of SPL for $12 million. Is the $12 million recorded in the financial statement of MHL? Answer is yes. At the day when MHL acquired control SPL, SPL have share cap, retained earning. These two added out is equals to $18 million. This $18 million represent the carrying value net assets. Then we have to ask, the next question is, any fair value adjustment? Normally there should be. The carrying value of the assets liability were the same as the fair value, except for a plant, which is a fair value of $1 million more than. That means we must increase the plant value. Plant by $1 million. We have to account for deferred tax because we are given the tax rate. Let's account for deferred tax liability. When we increase the value of the plant, we create a taxable differences which require a deferred tax liability to be recognized at 16.5%. 16.5% is 165,000. The total is the fair value of net assets. 18 plus 1 million minus 165. The fair value net assets equals to 18835. Do not forget we have this NCI. The company policy is to measure NCI, which is the 40% initially at acquisition date fair value. And the fair value NCI is equals to $8 million. If the NCI is a fair value, it means it's a full goodwill. On 1st Jan 2014, acquisition is 1st Jan 2012, to here 2014 is 2 years. And this date is 1 day after the year end. MHL sold 1/4 of its holding, 25% of its holding. Before that is 60%, minus 25% of 60%, 15%. After the disposable equals to 45%. 15% is the 25% of 60. After the disposable, it becomes 45%. At the date of the disposable of 15%, this represents carrying value net assets at the date of disposable. This amount is the same amount here. Because this figure is 31st December 2013, this figure is 1 day after 31st December 2013, 1st Jan 2014. The question is silent, we assume these two figures are the same. MHL sold the 15% for $4 million. The remaining 45% have a fair value of $12 million. Prepare the worksheet on 1st Jan 2014 after the disposal of 15% and assuming that the control is unaffected. You must come up with some working. SPL net assets. The starting point is always the year end, 31st December 2013. The net assets at this date is equal to equity at this date. It's equal to share cap plus reserve at this date. Share cap for SPL and the retained earning for SPL equals to 10 and 10. Now we have to work back to the acquisition date. The acquisition date was 2 years ago. 1st Jan 2012, acquisition date. 10 and 8. 3 and the balance is post. There's a plant assets of $1 million. Because of this plant assets, we must account for deferred tax liability at 16.5%. Deferred tax liability is 165. This go as a set. Total 18835. This represents the fair value net assets, 100% consolidated. Can we maybe calculate goodwill now? First, we have to take the cost of the 60%, $12 million. NCI of 40% is equals to $8 million. This figure given to us from the question itself. 12, 8. After that, we must less the fair value of net assets of SPL. Take the share cap, retained earning, the plant assets with a deferred tax liability. Where do you get this from? This column at the acquisition date. $10 million. This is $8 million. The plant assets increased by $1 million. Then we must account for deferred tax liabilities 165. Total is 18835. We should have a goodwill $12 million plus $8 million minus 18835. Goodwill is equals to 1165. We've answered the 4 marks ready. Can we put this working over here? Goodwill calculator is equals to 1165. Parent represents 60%. The cost is equal to $12 million. And the NCI is equals to 40%, $8 million. We take parent plus NCI minus the fair value assets equals to goodwill. We need to calculate what's the figure at this date. From the acquisition date to the year end, the post. From the acquisition date to the year end, increased by 2,000. This 2,000 is the post profits. When you increase the value of the plant, you must also increase the depreciation. When the depreciation is higher, profit is lower, tax should be lower. The plant assets at the date of acquisition have a remaining useful life of 5 years. We must increase depreciation over 5 years. From the acquisition date to now is 2 years. Take $1 million over 5, multiply by 2, because from the acquisition date to now is 2 years. the additional depreciation will be equals to 400 depreciation for the 2 year to date. When increase depreciation, reduce profit, reduce profits, reduce the tax, must account for the tax effect 16.5%, 66. 1666, this is the adjusted profits that 100% consolidated. Must let NCI share this 40%. 40% share of this, 40% share of this. Or you can take 40% share of the net amount. In this case, I take 40% share of the net amount. The NCI for these 2 years should increase by 666.4. The NCI at the year end is equals to 8666.4. When this is 100% consolidated, we minus this 40%. The 60% belongs to parent, 999.6. This will be the year end figure, 12999.6. Add across these two columns, PPE undepreciated amount is equals to 600. At the acquisition date is 1000, we use for 2 years. This amount is to be used over the next 3 years. Because of this PPE adjustment, remaining deferred tax liability, 600 multiplied 16.5%, is equals to 99 deferred tax liability. This will be the net assets consolidated. Beside this net assets, we have this goodwill here. This is the 100% consolidated, but we do not own 100%. We let NCI share. I need this 4 figure, 1, 2, 3, 4. Whenever there's changes in parent interest, these are the 4 important figures that I need the day before the change. Can we put this in the diagram? MHL investment in SPL at 31st December 2013 after 2 years of acquisitions. The net assets of SPL is equals to 20501. The goodwill consolidated before the control is lost is 1165. NCI represent 40%, 86664. If this is the amount assets liability consolidated, 86664 belong to NCI, how much belong to parent? The 60%, 129996. This is the figure before the change in parent interest in subsidiary. Now we talk about changes in parent interest over here. At the company level, the parent sold 25% of the investment. Must calculate the gain or loss on this disposable investment. In the separate financial statements of MHL, the disposable of 15% is considered as disposable of investment. If it's a disposable investment, you calculate the gain or loss on the disposable. So the investment for $4 million. Debit cash, $4 million, and credit investment. In the separate financial statements, we account this as disposable of investment. The investment before that, the cost $12 million. In the separate financial statements, the investment is recorded at cost. This is equals to 60%, and we sold 15% of the 60%. Take $12 million, multiply 15 over 60, 25%, 3,000. At the company level, there's a gain of $1,000. It's a gain on disposable of investment. At the company level, credit investment account for gain in P&L. Can we put this on the stable financial position of the parent? This is 31st December 2013. Can I change this to 1st Jan 2014? In MHL account, this will reduce by 3,000 because sold. Cash will increase by 4,000, receive cash. Then there's an increase of gain of 1,000 in P&L. This is recorded in the financial statement of MHL. Now at the group level, what must we do? The first scenario is control is lost. Minus the 15% is equals to 45%. No longer have control. No longer have control, deconsolidate. Deconsolidate must derecognize NCI. Compare this with the fair value to calculate the gain or loss in P&L. Case 1, assuming loss of control. If it's loss of control, we have to do a deconsolidations. We need to explain the step. Please refer to page 23. For this question is 60% minus 15% equal to 45%, assuming there's a loss of control. If loss of control, you must do a deconsolidations. These are the steps to do the deconsolidation. Derecognize the assets and liability. Derecognize NCI also. Calculate the gain or loss on the 60% upon loss of control. This entry pass at the company level, you must reverse at the group level. Debit back the investment, 3 million. Then we have to reverse the gain. This gain is a gain on the disposable of 15%. But at the group level, we don't have disposable of 15% investment. At the group level, we treat subsidiary as a business assets liability control and there's loss of control. This gain at the group level, we reverse 1 million. What happened to the remaining 45%? If it has significant influence, it's considered an associate. If it's no longer a significant influence, we call this as a financial assets. Whether it's associate or financial assets, when the control is lost, remeasure to fair value. According to the question, the fair value at the date of loss of control is equals to $12 million. After that, we have to deconsolidate. All this we must remove. Take out the assets liability, including goodwill. We must remove the NCI. First, we have to remove the NCI at carrying value, 8666.4. Then we have to deconsolidate the net assets of subsidiary is equals to 20501. Then we have to remove the goodwill 1165. There's a difference of 300.4. This gain is a gain on loss of control. This gain is a balancing figure, but what does this gain represent? This is the carrying value before the control is lost. When the control is lost, we must compare to fair value. So the 15% for $4 million and the remaining 45% is $12 million. There's a difference of a gain equals to 3,000.4. This gain and this gain is the same gain. Refer to suggest answer. First, we look at this A. We calculated this is the goodwill. I don't want to go through this again. Please do this yourself. For part B, discuss the effects in the separate financial statement and the group financial statement, assuming two circumstances, loss of control and control is unaffected. In the separate financial statements, whether control is affected or not is irrelevant. At the company level, we treat SPL as investment. We sold the investment 15%. There's a disposable of the investment. We have to debit cash, credit investment. There's a gain of $1 million. Whether control is lost or not, this will be the entry. Now look at part B1, disposable resulting loss of control. If resulting loss of control, then you must do a deconsolidation. De-recognize the asset liability of the former subsidiary SPL. The asset liability is 20501. Then recognize any investment retained. The investment retained is the 45%. If you have significant influence, will become associate. If you don't have significant influence, will become a financial assets. But whether it's associate financial assets, you must remeasure the fair value, go to $12 million. Any gain or loss, associate loss of control must be reported in P&L. The remaining 45%, assuming there's significant influence, we account this as an associate. This is entry that we passed earlier on. Please refer to page 23. Over here, when the control is lost, can I use this to answer the question just now? You cannot just copy, you must apply the questions. Upon loss of control over SPL at 1st Jan 2014, use the dates. Recognize the consideration received at fair value. We sold the 15% for $4 million. The remaining interest is the 45% at carrying value. You must adjust to fair value of $12 million. This 45% will become either associate, you have significant influence, if not, it's a financial assets. Then we must de-recognize the NCI of 20% at carrying value. The carrying value NCI is 8666.4. Do a deconsolidation including goodwill. The assets liability consolidate is 20501. Goodwill is 1165. Deconsolidate. Then we must recognize a gain or loss in P&L. In this case, it's equals to 3000.4. This 3000.4 is equals to the fair value of the 80% less the carrying value of the 80%. For this question, you can use this to answer the question. Obviously, you must apply to the question by using the company name, the dates, the amount, and so on. This is similar to the suggest answer. Case 1, there's a loss of control. Case 2, if control unaffected, you do not affect control, affect ownership. We call this as an equity transaction. You must tell the market, do not adjust the assets, including goodwill and liability of SPL. Because the control is the same. You control the same assets, same liability. We have to adjust the NCI. We still have control. Adjust the NCI. The investment credited, you must debit back the investment. The gain recognized at the group level, you must reverse. Because at the group level, we do not account subsidiary as investment. This gain on investment must be reversed at the group level. Debit investment, 3,000. Put back the investment. Reverse the gain, 1,000. Credit NCI. The question is, how much do we credit? When the parent interest drop, the NCI interest increase. If the parent interest drop, use this amount to calculate. If the NCI interest drop, you use this amount to calculate. Now the parent interest drop, you use this amount to calculate. But for this question, whether you use this amount or use this amount is the same answer. Because the question indirectly is telling us the NCI share of the goodwill and the parent share of the goodwill is based on 60-40. The control premium for the control interest was considered to be minimum, thus ignore. This to tell us that the parent did not pay a premium for the control. If the parent did not pay a premium for the control, the goodwill attributable to the parent attributable NCI is based on 60-40. Normally, we use this figure to do the calculations because the parent interest dropped 12,999.6. 12,999.6. This represents 60%. And the parent sold 15 of the 60% is equals to 3249.9 using the parent interest to calculate. If you use the NCI interest to calculate, in this case, you get the same answer. But in most cases, no. NCI is 8666.4 and 66.4 is 40%. Increased by 15%. You get the same answer, 3249.9. Calculate the balancing figure. 4,000 minus 3249.9. There's a difference of 750.1. It's a credit. It appears it's a gain, but we don't call this a gain. Just call this as a difference. It will be credited to the equity directly. You can credit to retained earning directly, or you can credit to other reserve. But it cannot go to P&L, cannot go to OCI. This is when the control is unaffected. Can you look at the suggest answer? Now look at number 2. If the disposal share with no impact of control, control is unaffected. If control is unaffected, but it affects ownership. Before, you have 60-40. Now you have minus 15. This one plus 15. This affects the ownership, so we have to adjust NCI. In the consolidated financial statements, when the changes in parent ownership in subsidiary do not result parent losing control of a subsidiary, we treat this as an equity transaction. That means it's a transaction between the parent and NCI. So in this case, we have to adjust the NCI accordingly. But when adjust the NCI, if there's any differences, plus minus, these differences must put back to the equity directly. This entry we pass as now, 750.1. So that's for part A and part B. Where do you find the information to answer these type of questions? Refer to page 23. No impact on control. For this question, is 60 minus 15 equals to 45. The question says, assuming control is not affected. We must tell the marker no adjustment to the assets liability of SPL. We must apply a question by using the company name. SPL should be consolidated as usual. Just the current amount of NCI. NCI you have to adjust from 40% to 55%. We treat this as equity transaction. If there's any differences, in this case it's 750.1. These differences will be recognized directly in equity. Do not recognize in P&L, do not recognize OCI. You can use this as part of your answer, but remember you must apply the question by using the company name, by using the percentage, by using the date. Can I go back to the question now? We have answer part A and part B. Now look at part C. Part C is assuming that the control remain to prepare the worksheet. This balance sheet given to us 31st December 2013, now in 1st Jan 2014. The first thing is that you must adjust this column. Then after that, we do the consolidation entry as usual. Then we have to add one more entry, changes that do not affect control. This entry. This answer. Your job is to fill in this column. Then after that, to pass the adjustment entry. We attempt the template is to have a better understanding and overview on the effect of the changes in the group financial statements. You must be able to explain the effects of these type of changes for examination purposes. Please take note that the figure in credit are shown in bracket. Take for example the share capitals, retained earning, liability. Positive represent debit balance or debit entry. Negative represent credit balance or credit entry. The first step before we do consolidation, we have to think about what happened to MHL account. This is the figure given to us. We must reduce this by 3,000 first because they sold 3,000 and the cash increased by 4,000. There's a gain reported at company level. This adjustment, you can put it here, or this adjustment, you can put it at the first entry, depending how comfortable you are. Depending on this figure, is it adjusted? If it's not adjusted, we have to adjust for them. Now look at adjustment entry 1, adjustment entry 2, adjustment entry 3. These are the easy ones. We have all the figure ready. The first adjustment entry at the acquisition date. All this figure will be used to calculate goodwill. This entry number 1. What's my entry number 1? Calculating goodwill. Entry number 1. Credit the cost of investment, credit the NCI, debit the share cap retained earning at acquisition date, increase the plant assets, account for deferred tax liability, and account for goodwill. Put this entry number 1 on the worksheet. Entry number 1, first we must eliminate the cost of $12 million. Then you must account for NCI fair value, eliminate share cap retained earning, increase the plant assets, deferred tax liability, and account for goodwill. The second adjustment entry is increase the depreciation, account for deferred tax. Adjustment number 3 is to let NCI share. First, we must increase depreciation, reduce PPE, credit PPE, debit retained earning, reduce the deferred tax liability, 66. The net of these two is equals to 334. 334, you must let NCI share, 133.6. Entry number 3 is to let NCI share the post profits. Entry number 4 is the adjustment entry we discussed on part B. This is entry number 4. Put back the investment, reverse the gain, increase the NCI, differences put back to equity. Debit back the investment. This investment that credited, we must put it back. If you don't put it back, this will become negative, which is not right. Reverse the gain, because at the group level, there's no gain on disposal investment. Increase the NCI, and the differences adjust back to equity directly. Add across. Please refer to page 51. Question 1.2 is a Module A questions to discuss the changes of parent interest that do not affect control. Study the questions, understand the issue. We're going to discuss this question shortly. Assuming that BDC is not subject to income taxes, we do not need to account for deferred tax. Part A, we're required to calculate goodwill at the acquisition date, 7 marks. Part B, you're required to calculate the amount of NCI at 1st April 2010 before the distributions to be reflected in the group account. You have to calculate what's the NCI at this date. Whereas goodwill, must calculate the goodwill at the acquisition date. Then part C, explain the accounting treatments and prepare the consolidation adjustment for the distribution of the preparation of the group financial statements of SCL, 4 marks. First, we try to understand the questions. On 1st October 2009, SCL acquired 80% interest in BDC. SCL investment in BDC, in this case is 80%, on 1st October 2009, which is the acquisition date, for $72 million. Fair value BDC share at the date was $45. 1st October 2009 is the acquisition date. 80% will give us control. BDC is considered as a subsidiary. $72 million is considered as the cost of control. These are a few information we always need when we calculate goodwill. In this case, NCI is equals to 20%. This 20% I believe should be a fair value. SCL have 4 shareholders with equal ownership. Adopt accounting policy to measure any NCI at its fair value. NCI 20% is a fair value. The subsidiary share is $45. And the question mentioned that on 1st April 2010, SCL distributed 300 shares of BDC representing 15% of BDC. NCI is equals to 20%. And 300,000 share is equals to 15%. 100% will be equal to 2 million shares, multiply 20%. And $45 each, $80 million fair value. This case should be equals to a fair value of $80 million. The carrying amount of BDC net assets reported in the balance sheet at the date obtaining control at the acquisition date was 42. Other than the property plant equipment with a carrying amount of 60, and the fair value is equals to 76. There were no differences between the carrying amount and fair value of all other reported assets liability. Reported assets, the only item is the PP, which have an excess of equals to $16 million. This $16 million is a pre-adjustment. We must include this as part of goodwill calculations. An internally generated IA with a fair value of $8 million was identified. The carrying value for this IA is equals to 0. Internally generated IA cannot be recognized, and assuming that this IA meet the definition of assets, part of the business combination, the fair value can be determined, then we must account for it at the group level. So in other words, there is a fair value assets also of $8 million on the IA. This is also a pre-adjustment. We increase the PPE and we increase the intangible assets, we must account for the depreciation. This depreciation is the post-adjustment. Both property plant equipments and intangible assets have an estimated useful life of 10 years from the date of acquisitions. At the acquisition date is 1st October 2009. At the date of distribution is 1st April 2010. Must account for 6 month depreciations. We have to take $60 million over 10 years, multiplied by 6 months. Depreciation after the acquisition date should be equals to $0.8 million. Intangible assets, we have to take 8 over 10 years for 6 months. The amortizations for the intangible assets is equals to 0.4. On 1st April 2010, SCL distributed 300 shares of BDC representing 15% to its own shareholders. Before that is 80%. SCL gives share to its own shareholders 15%. After that, 80% minus 15% equal to 65%. Assuming that 65% will still have control, it will still have control, it still consolidate. For this case, it's a change in ownership without affecting control. Let's adjust the NCI, 15%. To do this, we must have the usual working. We have to look at BDC net assets. At the date of the distributions is on 1st April 2010. This is the date of distribution which we need to do some discussions. We have to work back to the acquisition date. The acquisition date is on 1st October 2009. We need to know the net assets at this date. Normally what we do is we will take the share cap, retained earning, and reserve equals to the pre. But in this case, the question mentioned is equal to $42 million. So this 42 is equal to share cap plus reserve. At the date of acquisitions, PPE assets, $16 million. Another item is the intangible assets, which is $8 million. For this question, we do not need to account for deferred tax because the question says so. Add it up, equals to 66. $66 million is the fair value of net assets at the acquisition date. Maybe you can calculate the goodwill here. We have to account for the cost of the 80%, which is given to us, equal to 72. Whereas for the NCI, 20% is at fair value. This is not given to us. Just now we calculated 300,000 share represent 15%. If 300,000 share represent 15%, 100% will be equals to 2 million share. 2 million share multiplied by 20% will be equals to 400,000 share belong to NCI. And the value of the share of the subsidiary is equal to $45. The NCI fair value at acquisition date is equals to $18 million. Normally, how do you calculate goodwill? You have to take the cost of control plus the NCI minus the fair value assets. The difference is goodwill. 72 plus 18 minus 66. The goodwill at the acquisition date is equals to 24. This column is a very important column. The pre-column is for us to calculate goodwill. and the post is from 1st October to 1st April, we are looking at only 6 months. For these 6 months, BDC reported a profit of $8 million before accounting for depreciation and amortizations. The profit is $8 million for these 6 months,